What happens to the global economy when geopolitical tensions suddenly rise? When headlines mention missiles, military alerts, or rising conflict, something unusual often happens in financial markets. Stocks may fall, oil may jump, and one asset almost always grabs attention: gold. But why does gold often surge during moments of global uncertainty? Is it just fear, or is there a deeper economic pattern behind it? Let's break down what really happens to markets when geopolitical tensions rise, and why gold often becomes the center of attention. Throughout modern history, periods of geopolitical tension have created ripple effects across the global economy. Financial markets react quickly to uncertainty. When investors feel confident, money tends to flow into stocks, businesses, and riskier investments. But when uncertainty increases, especially during military tensions or international crises, investors often begin searching for stability. And that's where assets like gold enter the conversation. Gold has been viewed as a store of value for thousands of years. Unlike currencies, it isn't controlled by a central bank. Unlike companies, it doesn't rely on profits or earnings. So when uncertainty grows, many investors shift part of their money toward assets that historically hold value during turbulent times. But gold is only one part of a much bigger economic chain reaction. Let's start with oil. Energy markets are extremely sensitive to geopolitical risk. If tensions escalate near major oil-producing regions or critical shipping routes, traders begin pricing in potential supply disruptions. Even the possibility of reduced oil supply can push prices higher. And when oil prices rise, the effects spread quickly through the economy. Transportation costs increase. Manufacturing becomes more expensive. Airlines, logistics companies, and shipping industries feel the pressure almost immediately. Those higher costs eventually reach consumers in the form of more expensive fuel, transportation, and everyday goods. Now let's talk about the stock market. During periods of uncertainty, stock markets often react with volatility. Investors dislike unpredictability. If businesses face potential disruptions from higher energy costs, slower trade, or geopolitical instability, investors may reduce risk exposure. That's why stock indexes sometimes decline when geopolitical tensions make headlines. But markets rarely move in a straight line. Some sectors, such as energy or defense-related industries, may perform differently depending on the situation. Now here's where gold enters the picture. Gold is often considered a safe haven asset. This means investors tend to buy it when they want protection from economic instability, inflation, or currency fluctuations. When uncertainty rises, demand for gold can increase. And when demand rises faster than supply, prices can move higher. But gold isn't reacting to missiles themselves. It's reacting to uncertainty. Next comes the US dollar. Interestingly, the US dollar can also strengthen during global uncertainty. This happens because global investors often move money into large, stable financial systems during periods of risk. The United States hosts the world's largest financial markets and government bond market. So during uncertain times, global capital sometimes flows toward the dollar and US Treasury bonds. And finally, there's inflation. If oil prices rise significantly, transportation and production costs increase across industries. That can contribute to inflation over time. Consumers may begin noticing higher prices at gas stations, grocery stores, and shipping costs. While these changes don't happen instantly, energy prices often act as an early signal. So, in a single chain reaction, geopolitical tensions can influence oil prices, stock markets, currencies, inflation, and consumer costs. History shows that financial markets often react in similar ways during periods of global uncertainty. During the Gulf War in 1990, oil prices initially surged due to fears of supply disruptions in the Middle East. Global markets experienced volatility as investors tried to understand the potential economic consequences. Gold also saw increased interest during that period. A similar pattern appeared during the 2003 Iraq War, when energy markets reacted strongly to geopolitical developments. Even outside military conflicts, financial crises can produce similar investor behavior. During the 2008 global financial crisis, investors rushed into assets perceived as safer stores of value, including gold and government bonds. The reason is simple. When uncertainty increases, investors prioritize protection over growth. And that shift changes where money flows. But markets are not driven only by economic data. They're also driven by psychology. Human behavior plays a powerful role in financial decisions. When people see alarming headlines, the instinctive reaction is often caution. Investors begin asking questions. Could supply chains be disrupted? Could energy prices spike? Could businesses face slower growth? Even if those outcomes never fully materialize, the possibility alone can move markets. This psychological response is sometimes called risk-off behavior. Investors reduce exposure to risky assets, increase exposure to assets considered stable or protected. Gold benefits from this shift in sentiment, not because it generates profits, but because it historically preserves value during uncertain periods. Here's where it gets interesting. Experienced investors often look beyond the headlines. Instead of reacting emotionally to every geopolitical development, they focus on broader economic fundamentals. Questions like, how long might uncertainty last? Are supply chains actually being disrupted? Are energy prices stabilizing or continuing to rise? Is inflation accelerating? Professional investors often understand that markets sometimes overreact in the short term. Prices may spike or drop rapidly based on news, speculation, or sentiment. But over longer time periods, economic fundamentals tend to matter more than temporary panic. That's why many cautious investors focus on diversification, spreading investments across multiple asset classes rather than relying on a single outcome. So why does gold surge when missiles fly? It's not about the missiles themselves, it's about uncertainty. When geopolitical tensions rise, investors search for stability. Oil reacts to potential supply disruptions. Uncertainty. Currencies shift as global capital moves, and gold becomes attractive because of its long history as a store of value. But history also tells us something important. Markets eventually stabilize, economic systems adapt, and periods of uncertainty, while dramatic in headlines, are often temporary in the broader timeline of global markets. Which is why the most valuable asset during uncertain times isn't gold. It's clarity, staying informed, understanding the bigger economic picture, and remembering that markets respond not just to events, but to expectations about the future.